Welcome back to Wealthwise, the podcast where clarity meets strategy. Every time a major new policy is announced in Washington, the headlines explode, social media divides into warring camps, and the markets get choppy. It's noisy, it's emotional, and frankly, it can be exhausting. But what if, instead of getting caught in the crossfire of those debates, you could learn to see it all through a different lens? What if you could see it like an investor? Today, we're diving deep into a powerful and often overlooked topic: investing in government shifts. We're going to learn how to turn political headlines into a portfolio strategy. And to guide us, we have the perfect guest. He is a brilliant financial analyst, the founder of Briefs Pro, a firm that specializes in decoding the investment opportunities hidden within public policy, and a voice of incredible clarity in a world of financial noise. In this episode, you are going to learn three crucial things. One, why political news isn't just noise, but can actually be a treasure map for those who know how to read it. Two, three specific sectors where the government is actively funneling money right now, and how you can position yourself one step ahead of the crowd. And, most importantly, the core Wall Street mindset: how to separate emotion from opportunity and simply follow the money. I am so thrilled to have him on the show. Max Wise, welcome to Wealthwise.
Sarah, it's great to be here. Thanks for having me.
Max, let's jump right in. Whenever a new economic policy is announced, whether it's a tax bill, a spending package, or a new set of tariffs, the public reaction is almost always emotional and deeply divided. You see it on the news. You see it in your family group chats. Why do you believe that most people in the middle of all that debate are missing the huge financial opportunities sitting right in front of them?
That's a fantastic question, Sarah, and it gets right to the heart of the matter. The core reason is that we are psychologically and socially hardwired to react emotionally, not analytically, to these events. The public square, especially on social media, immediately becomes a battleground of morality and opinion. Is this policy good or bad for the country? Is it right or wrong? We're all conditioned to pick a side and defend it. Meanwhile, Wall Street is asking a fundamentally different and far more profitable question. Where is the money going? They operate with a level of emotional detachment that is their single greatest advantage. They don't care about the political debate, they care about the flow of capital. Let me give you a concrete example. A few months ago, a bill was passed that allocated billions of new dollars toward border security and immigration enforcement. The 24-hour news cycle focused entirely on the political drama and the human element. People argued passionately on Twitter and Facebook. But the savvy investor wasn't arguing. They were researching. They were opening their laptops and looking up publicly traded companies that build advanced surveillance technology, that provide logistics for government agencies, or, and this is a point that can make people uncomfortable, the private prison companies like CoreCivic or Geo Group, which are contracted to manage detention centers. As soon as that bill passed, their stocks popped, not because of opinion, but because Wall Street knew their revenues were about to increase.
So the information was public, it was the same for everyone, but the interpretation was completely different.
Exactly. It's not about having secret information, it's about having a different framework. Here's a quick case study. A major tax bill introduces something called 100% bonus depreciation for heavy machinery and vehicles. The public debate will be about fairness. Is this just a giveaway to big business? And that's a valid discussion to have. But the investor asks, how will this change spending behavior? They immediately start thinking about which companies will benefit. The last time we saw a policy like this, sales for specific heavy vehicles, like the Mercedes G-Wagon, skyrocketed among small business owners taking advantage of the tax write-off. An investor back then would have been looking at luxury auto manufacturers or, more broadly, at industrial giants like Caterpillar and John Deere, knowing that businesses were just given a massive incentive to buy new equipment. So you see, the difference isn't the information. The difference is the lens. One lens sees conflict, the other sees cash flow.
That's a fascinating reframe. It's moving from being a spectator in the political arena to a player on the financial field. The lens of cash flow, not conflict. So let's get practical. Let's put that lens on and actually look at the field. You've identified a few key areas where these government shifts are creating massive opportunities right now. Where should we start? That's a fascinating reframe, Max. Moving from being a spectator in the political arena to a player on the financial field. The lens of cash flow, not conflict. So let's get practical. Let's put that lens on and actually look at the field. You've mentioned these government shifts, and I want to break them down for our listeners into actionable pieces. Let's start with the most obvious one, direct government spending. This is when the government literally takes money from the Treasury and hands it to companies as a customer. In the current climate, where are you seeing those fire hoses of cash being pointed?
Absolutely. This is the most straightforward form of this strategy, what I sometimes call pipeline investing. You're looking for the direct pipeline from a government budget to a company's revenue stream. And right now, two pipelines are flowing stronger than almost any others: national defense and homeland security. Geopolitical instability, unfortunately, is a powerful and enduring tailwind for the defense sector. When you hear about new defense budgets being approved or international agreements where foreign countries are required to buy more arms from American companies, that's a direct signal. We're talking about billions of dollars flowing to companies that produce everything from fighter jets and tanks to the advanced software and cybersecurity systems that run them. Now, an individual investor might feel intimidated trying to pick one winner out of giants like Lockheed Martin or Raytheon. But this is also where thematic ETFs, exchange-traded funds, can be useful. Funds that focus on the aerospace and defense industry allow you to invest in the entire sector, betting on the trend itself rather than a single company's execution.
So you're not just betting on one horse, you're betting on the entire race because you know the prize money has just gotten bigger.
Precisely. And the second pipeline, Homeland Security, brings us back to that example of immigration enforcement and private prisons. This is where that idea of separating emotion from analysis becomes very real and, for some, very difficult. A bill is passed allocating an additional $14 billion for deportation operations and $45 billion for new detention centers. Again, the public debate is fierce, but the investor's question is simple. Who builds and operates those centers? The answer leads you directly to publicly traded companies like CoreSigic and GEO Group. The moment that bill was signed into law, Wall Street's algorithms and analysts knew that these companies were about to receive a flood of new, guaranteed government contracts. Their future revenue wasn't speculative, it was legislated. Their stock prices reacted accordingly, jumping almost immediately. The key takeaway here is that you don't need to have a moral opinion on the policy to recognize the financial implication. You just need to follow the dollars.
That's so clear. It's about reading the budget, not just the headlines.
Don't just read the title of the law, read the line items. The headline is for the voters, the line items are for the investors.
Okay, so that's direct spending, the government as a massive customer, but you also mentioned that the government can steer the economy in more subtle ways, using incentives rather than direct contracts. Let's talk about tax policy. You brought up a specific change in the tax code that could trigger a huge wave of spending. Can you break that down for us?
Yes, this is my favorite part because it's less about force and more about the art of the nudge. It's about understanding how the government uses the tax code to encourage specific behaviors. The policy I'm referring to is the expansion of Section 179, specifically the provision for 100% bonus depreciation. Now, that sounds incredibly boring and technical, so let me make it simple. Think of it like this. Normally, if your business buys a $100,000 piece of machinery, the IRS makes you take the tax write-off for that expense slowly over several years. Maybe you deduct $20,000 this year, $20,000 next year, and so on. It's a slow drip. But with 100% bonus depreciation, the government essentially lets you turn on the fire hose. You get to deduct the entire $100,000 cost from your business income in the very same year you buy it. For a profitable business, this is a massive incentive. It dramatically lowers their tax bill today, not 5 years from now.
So it creates an immediate, almost urgent reason to spend money on new equipment.
Urgent is the perfect word, and here's where it gets interesting for investors. This policy applies to heavy machinery and, crucially, to heavy vehicles, those with a gross vehicle weight rating over 6,000 pounds. The last time a similar policy was in effect during the Trump administration's first term, something fascinating happened. Sales of the Mercedes-Benz G-Wagon, which qualifies as a heavy vehicle, went through the roof. Small business owners and entrepreneurs who were always looking for ways to optimize their tax situation suddenly saw a $150,000 luxury SUV not as an expense, but as a giant immediate tax deduction. So while the public might debate whether that's a loophole, the investor is asking, okay, who benefits from a surge in heavy vehicle and machinery sales? The obvious answers are industrial titans like Caterpillar and John Deere, but it also benefits auto manufacturers with popular heavy-duty trucks like Ford with its F-Series and GM with its Sierra line. The ripple effect is huge. The only caveat this time around, which makes the analysis more nuanced, is the interest rate environment. The free money era of the pandemic is over, so while the tax incentive is powerful, business owners will still be more cautious about taking on debt. But for healthy, profitable businesses, the math is still incredibly compelling.
It's like the government is putting a giant sale sign on specific categories of goods, and your job is to figure out who sells them.
The tax code isn't just a rule book for paying the government. It's an instruction manual from the government on how they want you to invest and spend your money.
All right, so we've covered direct spending and tax incentives. Let's move to the more confrontational policies. I'm talking about tariffs. To the average person, tariffs sound entirely negative. They're a tax on imports, they raise prices for consumers, they can spark trade wars. It feels like a brake on the economy. Where is the opportunity in that?
You're right. The initial perception is always negative, and for many businesses, the impact is negative. But again, we have to put on that analytical lens. An investor's job isn't to judge the policy's overall economic merit, but to find the specific pockets of advantage it creates. I like to use the greenhouse analogy. A tariff on foreign steel is like a giant protective wall for some and a costly barrier for others. If you're an American car company that relies on imported steel, that tariff is a wall that just raised your costs. But if you are a domestic steel producer, that wall has just become the frame for your own private greenhouse. Suddenly, your foreign competition is more expensive, giving you a massive competitive advantage in your home market. You are shielded, protected. You can potentially raise your prices and capture significant market share. The policy is designed to benefit you.
But it can't be as simple as just buying any company with U.S. steel in its name, right?
Exactly. This is where due diligence becomes absolutely critical and where many investors go wrong. They do the first level of analysis. Tariffs are foreign steel, so I'll buy American steel companies, and then they stop. You have to go deeper. Let's take Alcoa, a major American aluminum producer. On the surface, they seem like a clear winner from tariffs on foreign aluminum. But when you dig into their operations, you might discover that a significant portion of their raw metal is actually sourced from smelters in Canada. So even though they are an American company, they are hit by the very same tariffs when they import their own materials into the U.S. to be processed. The real winners are the companies that are vertically integrated within the United States. Companies that source their raw materials and conduct their manufacturing domestically. Someone like Nucor or Steel Dynamics, which operate mini mills that often use recycled scrap metal from within the U.S., are in a much better position to benefit. They are truly inside the greenhouse, while others are left trying to climb over the wall.
So the lesson is to not just read the policy, but to understand the supply chain of the companies you're looking at.
A tariff is a wall for one company, but it's a greenhouse for another. The investor's job isn't to tear down the wall, it's to find out who's growing inside the greenhouse.
Max, this is all incredibly insightful. We've talked about defense, taxes, and trade, all very grounded, traditional industries. But I want to look forward a bit. What about the more ambitious, almost science fiction-like government shifts? I'm thinking of things like the renewed push into space. Is there a real investment thesis there, or is it still just a dream?
That's the perfect place to end this section because it bridges today's reality with tomorrow's potential. Investing in the space industry is a prime example of a government shift driven by long-term strategic ambition. This isn't just about quarterly earnings. It's about national pride, technological dominance, and, frankly, a new domain of national security. When the government establishes something like the Space Force or signs directives like the Iron Dome for America that allocate billions to space-based defense systems, it sends a powerful message. It tells the market that this is no longer a hobby for a few billionaires. It's a national priority backed by the full financial weight of the United States.
So, how does a regular investor even begin to approach something so vast? It's not like we can buy stock in NASA.
No, you can't. And you can't buy stock in SpaceX yet. But you can invest in the picks and shovels of the space gold rush. You invest in the vast ecosystem of public companies that will benefit from this flood of government contracts. This includes the established defense giants like Northrop Grumman and Lockheed Martin, which have massive space and satellite divisions. It also includes more specialized players. Think about companies that produce rocket boosters, satellite components, or the communication networks that link everything together. Companies like Rocket Lab, which focuses on smaller satellite launches, or Viasat, which is a leader in satellite communications. Once again, for those who don't want to pick individual stocks in such a speculative field, there are ETFs like ARKX or UFO that bundle these companies together. But I have to end here with a crucial warning. This sector is inherently riskier and more speculative than steel or machinery. Just because the government is spending money doesn't guarantee every company will succeed. Rockets can fail on the launch pad, contracts can be lost to competitors, and technologies can become obsolete. The research you do on a company's leadership, its unique technology, and its financial health is more critical here than anywhere else we've discussed.
It's a higher risk, but potentially a much higher reward, tied directly to a national vision.
Investing in space isn't about betting on a single rocket launch. It's about investing in the essential infrastructure of the final frontier. It's a long-term bet on human ambition, backed by government dollars.
Max, this has been an absolute masterclass in reframing how we look at the news. We've gone from direct spending to tax incentives to trade policy and all the way to the final frontier.
Max, this has been an absolute masterclass in reframing how we look at the news. The logic is so clear. Follow the direct spending, understand the tax incentives, find the greenhouse in the trade storm. It sounds almost foolproof when you lay it out, but we both know investing is never foolproof. I have to ask, has there ever been a time when you followed this exact framework, you identified a powerful government shift, and you still got it spectacularly wrong? A time when the market taught you a lesson you've never forgotten?
Spectacularly is the right word, and yes, absolutely. Anyone who says they haven't made a huge mistake is either lying or hasn't been in the game long enough. For me, that defining moment came during the big green energy push about a decade ago. The political climate was electric. There was a massive government stimulus package with billions of dollars in grants and loan guarantees for clean energy companies. It was the headline everywhere, the dawn of a new energy era. And as an analyst, I felt like I had a cheat code. The government was literally telling the world where it was going to throw its money. It felt like the easiest trade of my life. So I did my research on the trend. I found a company, let's call them Solus Tech, that had what looked like revolutionary solar panel technology. They were the darlings of the media, their CEO was on every news channel, and they were a prime candidate to receive a massive government loan. The story was perfect. The government shift was undeniable. So I invested. not just for my clients, but a significant amount of my own capital.
And I'm guessing it worked at first?
Oh, it worked beautifully at first. The hype was real. They secured a huge government-backed loan, and the stock popped. I remember looking at my screen and feeling like a genius. I had followed the framework: identify the government shift, find a company positioned to benefit, and invest. I thought I'd cracked the code. But then, small things started to seem off. I was reading their quarterly reports, the boring documents everyone ignores, and I saw that their cash burn rate was accelerating at an alarming pace. They were spending money much faster than they were making it, even with the government loan. Their debt was piling up. The revolutionary technology they promised was facing constant delays and manufacturing hurdles. I was blinded by the power of the government-led trend that I had committed the cardinal sin of investing. I fell in love with the story and ignored the financials. I forgot that a government tailwind doesn't fix a leaky boat.
So what happened?
Within 18 months, Solus Tech filed for bankruptcy. The government loan was gone. The revolutionary technology never made it to mass market, and my investment, along with that of thousands of others, went to zero. It was a cold, hard lesson in humility. I had to call my clients and explain how I'd been so wrong. But more importantly, I had to explain it to myself. That failure taught me the most important lesson of my career, which is the missing piece of the puzzle we've been discussing today. It's this: the government shift tells you which ocean to fish in, but it doesn't tell you which fish are healthy. The government can create a perfect environment for an industry to thrive, but it cannot make a poorly run company successful. My mistake was assuming the government's endorsement was a substitute for my own due diligence on the company's fundamentals, its leadership, its balance sheet, its ability to actually execute. I had analyzed the theme, but I hadn't analyzed the player. And I've never made that mistake again.
Wow. Thank you for sharing that, Max. That story perfectly illustrates the danger of just chasing a trend without doing the deeper work. So, looking ahead, as the world gets more complex and these shifts happen even faster, what do you believe will be the single biggest change in the next 3 to 5 years that will define financial success for the individual investor? What's the next tool or trend that will help us avoid those kinds of traps?
That's the perfect question to bridge from that lesson. If the past was about getting access to information, the future will be about the synthesis of information. And the tool that will drive this is the one everyone is talking about, but for a different reason. Artificial intelligence applied to policy analysis. Right now, even for professionals, much of our analysis is what you'd call first-order thinking. We hear about a tariff on Chinese steel and we think, okay, American steel companies will benefit. That's level 1. But what AI will allow the individual investor to do is to see the second, third, and fourth order effects almost instantaneously.
Can you give us a concrete example of what that would look like?
Sure. Let's imagine a new complex bill is passed that places a heavy tariff on a specific type of microchip imported from Taiwan. Level 1 thinking, what we do now. This is bad for Taiwanese chip makers and good for American chip makers. Level 2 thinking, what AI will do for you. An AI tool will scan the supply chain disclosures of every public company and instantly flag that a specific American car manufacturer, let's say Ford, relies heavily on that exact chip for its electric vehicle line. So Ford stock might be at risk, even though it's an American company. The AI also identifies a Malaysian company as the next best supplier, highlighting it as a potential second-order winner. Level 3 thinking, the real game changer. The AI models the potential economic impact. It predicts that a massive shift in demand to Malaysian suppliers could strengthen the Malaysian currency, which in turn could impact the price of palm oil, another major Malaysian export. Suddenly, from a single policy announcement, you have a complex web of potential risks and opportunities that would have taken a team of Wall Street analysts weeks to uncover. In the future, you'll have it in seconds. The game is shifting away from who gets the information first to who can analyze the connections deepest. The retail investors who learn to leverage these AI tools won't just be leveling the playing field with Wall Street. In some cases, they'll be able to see things the slow-moving institutions miss.
The future is about depth, not just speed. Max, this has been an incredibly empowering conversation. Thank you so much for your time and for sharing your wisdom and your hard-earned lessons with us today. For everyone listening, I hope you're walking away with a completely new lens for viewing the world. We learned about the clear opportunities in direct government spending in sectors like defense. We demystified the tax code, seeing how incentives like bonus depreciation create powerful economic nudges. And we learned to see tariffs not just as a wall, but as a greenhouse for specific domestic industries. But most importantly, we learned that a trend is not a strategy until it's paired with deep, fundamental research. If you found value in today's episode, please do 3 things for us. It's how we grow and reach more people just like you. 1. Share this episode with one friend or colleague who you know is trying to build their financial knowledge and get ahead. 2. Subscribe to WealthWise on whatever platform you're listening on so you never miss a weekly breakthrough. And 3, leave us a review or a comment. We read every single one, and we'd love to hear what resonated with you the most from today's conversation. Max, thanks again for being here.
My pleasure, Sarah. It was a fantastic discussion.
And to all of our listeners, remember the powerful tagline of this show. Financial freedom isn't a dream, it's a strategy. And as you navigate the news this week, keep today's final lesson in mind. The market doesn't vote. It doesn't argue. It just follows the money. Learn to read the map